Let's face it, for a lot of us, the words investment taxes are enough to make your eyes glaze over. It feels complicated, a little intimidating, and you're probably worried you're leaving money on the table. But what if I told you that getting a handle on this system is one of the best ways to actually boost your returns? Well, that's exactly what we're going to do. We're going to break it all down step by step. Here's our game plan. First, we're going to crack the code on how tax brackets actually work in Canada. Then we'll settle that age-old question. What's better, a deduction or a credit? After that, we dive into the really juicy stuff, how your different investments get taxed. And finally, we'll turn all that knowledge into some really smart strategies you can use. Ready? Let's jump in. All right, first up, let's talk about the absolute foundation of our tax system. It's called a progressive system. And, the way it works is probably the biggest source of confusion out there. So, here's the classic question I hear all the time. If you're in, say, the 20.5% tax bracket, does that mean you pay 20.5% on your entire salary? It seems logical, right? But the answer is a big, fat no, and understanding why is everything. This brings us to a super important idea, the marginal tax rate. Honestly, the easiest way to think about it is to picture a set of buckets. Your income starts filling up the first bucket, and that bucket gets taxed at the lowest rate. Once it's full, your money spills over into the next bucket, which gets taxed at a slightly higher rate, and so on. Your marginal rate, that's just the tax rate you pay on the last dollar that goes into your final bucket. So this table shows you exactly what those buckets look like using the 2020 federal rates. Now, the numbers themselves change a bit year to year, but the idea, the concept, that stays the same. So let's make this real. Meet Ben. Let's say he has $50,000 in taxable income. How much tax does he actually pay? First things first, we fill that bottom bucket. So the first $48,535 of his income is taxed at that low 15% rate. That comes out to just over $7,200. Easy enough. But wait, Ben earned more than that. So the rest of his income, that's $1,465, spills into the next bucket. And that little bit gets taxed at 20.5%. That adds another $300 to his tax bill. So what's the final bill? You just add the tax from each bucket together. His total federal tax is $7,580. Notice, it is not 20.5% of his whole 50 grand salary. It's much, much lower. That is the progressive system in action. And this is the big takeaway right here. Ben's marginal tax rate is 20.5%, because that's the rate on his last dollar. But his average tax rate, the actual slice of his total income that went to taxes, is only 15.16%. This difference is so important, because when you make investment decisions, you always want to be thinking about your marginal rate. Okay, so we know how our tax is calculated. Now for the fun part. How do we legally pay less? This is where the real power is, and it starts with knowing that not all tax breaks are the same, not even close. Let's look at Jose. He makes 100 grand, and just to keep it simple, his marginal tax rate is 40%. Now look what happens. A $5,000 deduction saves him 2 grand in tax, but a $5,000 credit, that saves him the full 5 grand. So why the huge difference? It's all about when the savings get applied. See, a deduction, think of an RRSP contribution, it works right at the start. It's subtracted from your total income before any tax is calculated. So it just makes the pile of money that gets taxed smaller from the get-go. A tax credit, on the other hand, is a superstar that shows up at the very end. You figure out your total tax bill first, and then you subtract the credit, dollar for dollar. It's basically like having a gift card to pay off your taxes. That direct reduction is what makes credit so incredibly powerful. All right, basics are done. Now we're getting to the heart of it. For investors, it's not just about how much you make, it's about how you make it. Because as you're about to see, the CRA has totally different rules for different kinds of investment income. Okay, pay really close attention to this slide. It is the master key to this whole section. Your investments make money in 3 main ways, and they are not treated equally. Interest income is the worst from a tax perspective. Every single dollar is taxable. Capital gains are the best, only half is taxed. And sitting right there in the middle, you've got Canadian dividends, which have their own special system with tax credits. This is where people's heads start to spin. The whole system for taxing Canadian dividends has this kind of weird 2-step process. It feels so complicated. So why does the government do it this way? Well, the reason is actually pretty simple and pretty fair. The whole point is to avoid double taxation. I mean, Think about it. The Canadian company that paid you that dividend, it already paid corporate taxes on its profits. So this system is just the government's way of giving you, the investor, a break for the taxes the company already paid. It stops that same chunk of profit from getting taxed heavily twice.
And that brings us back to the most tax-friendly income there is, capital gains. It's beautiful in its simplicity. When you sell an investment for more than you paid, only half of your profit gets added to your income and taxed. That 50% inclusion rate is what makes capital gains the absolute best way to build wealth in an account that isn't an RRSP or a TFSA. Okay, theory time is over. We get tax brackets, we get credits, and we know about the 3 types of investment income. Now let's put it all into practice. How do we use this knowledge to invest smarter and, keep more of our own money?
This right here is the golden rule. It's probably the most important strategy for building wealth over the long haul. The idea is simple. You want to hold your least tax-efficient investments, the stuff that gets taxed the most, inside your tax shelters, like an RRSP or a TFSA. So let's say Maria has a bond fund that pays out fully taxed interest and an equity fund that generates tax-friendly capital gains. She should absolutely put that bond fund in her RRSP. That way, all that inefficient interest income can grow and compound year after year, completely tax-free.
Okay, one last pro tip for you, and this one can save you from a really annoying tax surprise. It's a mistake a lot of people make in those last few days of the year. So the question is, could the timing of your purchase actually be setting you up for a tax bill?
This is what's called the year-end tax trap. Check out what happens to Sammy. He puts $1,000 into a fund on December 30th. The very next day, the fund pays out all the capital gains it made over the entire year. So even though Sammy was only in the fund for one day, he gets that distribution and now he owes tax on it. He literally bought himself a tax bill for gains he never even took part in.
So the takeaway here is super simple. If you're planning to buy a fund in a non-registered account near the end of the year, just check when it makes its distribution. If a big one's about to happen, just waiting until January 1st to buy can save you a completely unnecessary tax headache. It's a tiny adjustment that makes sure your money is working for your future, not for a past you weren't even there for. Pretty cool, huh? It really makes you wonder, what other little pieces of knowledge could make a huge difference to your bottom line?